bye, 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 bye.
I know I'm a grifter, strong man. You could lick your hand and smack me in the nutsack. Thank God for Tesla my Esla and you, strong man.
Bye, 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 bye. Just buy stocks because they only go back up. Welcome back, Strongman Personal Finance. My name is Christopher Belly. I'm a certified CPA accountant. I'm a fake boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. And that's right, ladies and gentlemen. We're going to do a discounted cash flow analysis using GAAP earnings. And we're going to figure out the intrinsic value of Corsair Gaming. That's right. You know what Corsair Gaming is? It's a gaming hardware company. You go on the internet with your stimmy check. Oh, wait, we don't have those anymore. And you buy some hardware and you build your own PC. That's Corsair. And it's the future, bro. And I actually watch a guy that plays StarCraft. His name is Artosis. And I think he's sponsored by Corsair. So it must be a 10x stock, bro. And always remember, ladies and gentlemen, you always discount your future cash flows at the federal funds rate. We'll get to that in a second. So let's go ahead and check out Corsair's financial statements, because investing is all about, not looking at the balance sheet, income statement, or statement of cash flows, but just buying a stock because it's exciting and cool and it went up a lot. That's how it works nowadays, okay? You don't have to worry about, earnings. You don't have to worry about profitability. You don't have to worry about anything. The only thing that matters is growth, my health. So this is the income statement of Corsair Gaming. Remember, it's a gaming hardware company. First line, revenue by avenue. Now, nothing excites me more than a company that has very massive revenue decline. As a matter of fact, for the 6 months ended June 30th, if you compare it from 2021 to 2022, it looks like Corsair roughly had a 35% decline in revenues. 35%! Almost like it was in a bubble. Doesn't matter! Bye, 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 bye! Okay? Now, let's go down and look at the quarterly profit. So we can see the net revenue for the 3 months ended June 30th, 2022. I know this is boring. I'm not going to tell you that. Bye, 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 bye! Is $283 million. And the gross profit is $36 million. Let's see the amazing gross profit margin of this company. Divided by 283,908. The gross profit on the top of the income statement, and there's a lot more expenses. The gross profit is basically, if Corsair is buying hardware, they buy the hardware and then they sell it to you. The difference between what they paid for the hardware and what they sold it to you is the gross profit. But you have other expenses after that. You got to pay your staff. You got to do marketing. You got to sponsor LaFufu. You got to sponsor Artosis. All that crap. But at the top of the income statement, the gross profit is 12%. It seems like Jeremy likes companies that have very low gross profits, like Tattoo Trucker, Sweaty Petras, and Nutsack. And Corsair My Horsehair. Not very good, okay? Let's go down the income statement. Selling, general, and administrative expenses, $73 million, and product development, $18 million. So it looks like year over year, product development went up. Selling, general, administrative expenses went down. Total operating income. What is the profit before interest and taxes? Well, what are those? What do those mean? Those little brackets. What does that mean? Oh, it's unprofitable. Woo, boy! Oh, ow! It looks like Corsair My Horsehair has an operating loss of negative 19%. That's a stock you should buy, bro. So it's massively unprofitable. And I can tell you what happened. A bunch of people got stimmy checks 2 years ago. Corsair's revenue went up. Profits went up. They did amazing. Stimmy checks ran out. Blah, 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 blah. Now they're losing money like they were before. What a freaking shock, okay? So basically the income statement is garbage. I mean, you can see the bottom of the income statement. It's like negative 18%, negative 19%. Freaking garbage, okay? And we can see the basic shares outstanding have gone up. So it looks like they've issued shares. So you get share dilution and you get unprofitability. I'm sold so far, but we're still going to do a DCF, okay? because I'm going to show you what a 10x this stock is, because if you discount it by the federal funds rate, you can make a lot of money. Okay. Let's look at the balance sheet. So Jeremy thinks there's 3 of these, and maybe I'm wrong. Maybe I'm an idiot. Maybe there are 3 balance sheets. Let's look at changes. So on the right, we have December 31st, 2021, and we have June 30th, 2022. It's a comparative balance sheet. You can actually see how stuff changed over time. So we can see their cash went down by a pretty significant amount, roughly, what is that, $25 million, something like that. Restricted cash, restricted for, I don't know, Bussy, is down a little bit. Accounts receivable is down pretty significantly. Inventories are roughly the same. That's interesting. And prepaid expenses are up. So their total current assets have gone from $705 million down to $554 million. That's a pretty significant decline in current assets. Why? I don't know what they did with it. We can go look at the statement of cash flows later. But if they're burning cash, that ain't a good sign, okay? Let's see. Restricted cash, non-current, whatever. PP&E. So they bought a little bit of property, plant, and equipment. You can see it went up a little bit. Goodwill went up a little bit. That means they acquired something. I wonder, what is Corsair acquiring with all their massive profits? Intangible assets have gone up a little bit. And other assets have gone up. So their net change in assets has gone from 1.33 million to 1.23 million. That's a pretty significant decline in assets, my schlassets. Okay. Let's go down and look at current liabilities. Debt maturing within 1 year, only 4.7 million. That's really not that bad. Accounts payable 1.9 and other liabilities, accrued expenses 1.5. So their total current debts that are due within a year are $356 million. We go look and we can see, we compare that to current assets. Well, it really all depends on this inventory right here, because you could see inventory may not be liquid. They may not be able to churn out inventory that much, but they have an okay amount of cash, restricted cash for God knows what, and a bunch of receivables. And if you take out inventories and prepaids, their quick ratio is not that great, okay? I'm not saying they're going to go bankrupt, but they may have to borrow money, because if they can't sell this inventory, they have issues selling it, they might have some cash problems, okay? Let's go down. Long-term debt, $240 million. So it looks like their long-term debt actually went down a little bit. I guess that's okay. So nothing insane. Deferred tax liabilities. Basically, if you save taxes now on your tax return and you have to owe taxes in the future because of temporary differences, that's a deferred tax liability. So that went down a little bit, and other liabilities. So it looks like their book value, let's see how much their book value has changed. Their total book value has declined by a couple of percentage points, okay? Let's look at the common stock. So they've issued some stock. Additional paid-in capital went up. They issued stock. Retained earnings went down. That's interesting. Retained earnings is your accumulated profit and loss since the history of your company, and it's affected by other things. But basically, think of it as your storage of profit and losses from the income statement. Retained earnings has gone down from $98 million down to $33 million. If Corsair has one more 6-month quarter that is as bad as this, they're going to have negative retained earnings because they lost $54 million on a GAAP basis in 6 freaking months. And they lost basically that in 3 months. So if you go down and look at the retained earnings, they will have a cumulative history of losses if you add all the gains and profits and losses together, if they have another bad quarter, which they may very well. So ain't looking too hot so far. Let's go down and look at the statement of cash flows. So apparently they have a little bit of operating cash flow. They have positive operating cash flow. Okay. I guess that's good, but look at the decline year over year. For the 6 months ended June 30th, 2021, they had almost 60 million of operating cash flow. Now they have 10 million of operating cash flow. Okay. So what do you think about that, guys? I don't know. It seems like it could go negative again at some point. We'll see. All right, we'll go down. Looks like they acquired a business for roughly $20 million. Payment of deferred contingent consideration, whatever that is, 95, looks like $95,000. They bought some property, plant, and equipment, almost $12 million. And it looks like they bought a short-term investment. Investment in a convertible note. Okay. Whose convertible notes are they buying? Interesting. Let's go look at the financing activity. So overall, their free cash flow is negative. Look at their operating cash flow and then look at their capital expenditures. They spent more on buying new assets than they had an operating cash flow. So your free cash flow yield is negative. Good job, Corsair. Okay. What do they do on the financing? They paid a little bit of debt. They borrowed from a credit line and then they paid off a credit line. So I guess they needed the money in a pinch. Payment of contingent consideration. So overall, I'm a little concerned about their balance sheet. It's not the worst I've ever seen, but if they have inventory problems, because look, all the other current assets have declined precipitously, but their inventory has stayed the same. So I don't know if they have a huge pileup of inventory, and if they have a hard time converting that into cash, they may have to go into more debt or issue more shares. Because if you look at their current assets that are liquid and you compare that to their total debts that are due within a year, they're not sitting too pretty. Okay. So I could definitely foresee some kind of, either more debt, maybe a credit line like they did before, or they could issue more shares. We'll see. Let's go look at the history of Corsair's earnings. Okay. So we can see in 2018, they had almost $1 billion of revenue. 2019, they had a 17% increase. That's okay. 2020, they had a 55% increase. And then in 2021, 11% increase. This was because of the pandemic, okay? We go down and look at share change. Shares going up. They're issuing shares pretty significantly, all right? Gross profit. Look at the history of their gross profit. 2020, 27, 27. They're getting squeezed, man. And inflation, it's probably inflation that's really hurting this company's profit margins because now their gross profit is like 12%. Or maybe they have structural issues. I don't know. But inflation is definitely squeezing this company probably. Operating margins. Look at the operating margins, okay? Before the pandemic, the operating margins were like 2%, okay? They were barely profitable from an operation standpoint, and that's not including interest and taxes. After interest and taxes, their profit was negative. They lost money. And they had a little blip of profitability during the pandemic. And now it's declined back to losses. And their free cash flow margin, they had a brief bump in free cash flow. But even during the height of the pandemic, when everybody had their STEMI checks, everybody was working from home, they had a 10% free cash flow margin. Wow. Okay. Let's go ahead and do a discounted cash flow. And before I do this, this is a joke, okay? I'm not buying this stock. If you see me do this, you shouldn't buy this stock. This is literally a joke because I would never discount the future cash flows of a company at the federal funds rate. And Jeremy did a DCF, or no, he doesn't know how to do a DCF, but he said that when Wall Street does DCFs, they discount at the federal funds rate. The federal funds rate, for my brief introduction to economics, is the intraday lending rate that banks lend to each other. So one bank let's say one bank is a little bit low on cash, or maybe they don't meet the, reserve requirement ratio. And they're like, hey, JP Morgan, I'm Chase. Well, okay, whatever. It's two different banks. Like, hey, I need some cash overnight. Well, the rate that the one bank charges the other, if you annualize that out, that's basically the federal funds rate, okay? If you wanted to value a stock, if you wanted to discount the future earnings of a stock back to the present, why would you use a rate that banks lend to each other? Maybe you could use a treasury. Let's say you want to invest for 10 years. Maybe you could use a 10-year treasury plus like some kind of, risk premium or something like that. That might make more sense. But to identify the federal funds rate as the discount rate, is stupid. Okay. So whatever number you see pop up here, it's a joke. Don't buy Corsair because it's going to be a massive number probably. Don't buy it unless you want to, but don't take this seriously. This is a joke. Okay. I have to say that because some of you guys, oh, wow, it's a buy. It's a joke. Okay, look at my eyes. It's a joke. So let's go ahead and do this DCF. And if you can see up here, the name of this is SEDCF because I literally threw this together over lunch. And basically all I do is I plop in the trailing 12-month revenue. I did Tesla before this. I put in the shares outstanding. I put in the profit margin assumption. This is based on the income statement. The PE of the company when you sell it, the discount rate, the revenue growth assumption, and the share change assumption. And then basically all this DCF does in year one, that's the revenue. Here's the revenue. Here's the revenue, blah, 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 blah. And then you have the net income. And all I do is I take the revenue times the profit margin. You can see the formula right here. Revenue times the profit margin. Then I divide it by the shares outstanding, which change based on share issuance. And I get my earnings per share. And then I discount the earnings per share at the discount rate. Because over time, the further out the earnings are, the bigger your discount factor and the lower the present value. Okay. So basically all I do is I discount all this and then I add up the discounted earnings per share. And that includes what you would sell the stock for at disposition. Disposition means like when you sell the stock. So what I'm assuming is, and once I punch in the numbers, you'll see, I'm assuming this will be the share price based on the trailing 12 months earnings and the price to earnings ratio in my assumption. And then I'm going to multiply that by, well, obviously by the PE ratio. And then I'm going to discount that because when you sell a stock, think about it, it's like a cash inflow. So you buy a company, you get earnings, money coming in theoretically every year. And then you sell the stock and you get that inflow of cash. That's like part of your DCF. So the PE is actually a big part of your DCF. And that last cash inflow from selling the stock is part of the DCF. And then I literally just add up all the discounted cash flows. That's all I do. Now, if this is totally wrong, somebody can tell me, but that's why I call it the SEDCF. And I'm an index fund investor. So let's go ahead and fill out this DCF. So trailing 12-month revenue, and pretend I'm Jeremy LaFufu. Hey guys, I'm a gas station manager. Bye, just buy everything, bye. Let's go ahead and do, what is it, 1.5, 1.566, 000. So their trailing 12-month revenue is $1.56 billion. Okay. Oh, it's a buy at $2. Shares outstanding. Bye. I guess that's 95 million. Let's double check. Where's the balance sheet? Bye. You just have to buy. Yeah, it looks like there's 95 issued and outstanding. 95.7 shares outstanding. 9578000. Okay, so we have 95 million shares outstanding. Profit margin. Now, what we're going to do, because, you're LaFufu, is we're going to use the highest profit margin they had during the height of the pandemic. Because obviously that's going to go forever into the future. So it looks like their highest profit margin was 6, my big, 6%. So we're going to say their profit margin is 6%. Their PE at disposition. Well, let's go look at the history of their PE. My PE. So PE 23, negative 32, 41, 19, 20, 19, 20. Let's go look. Let's go look at the PE before the pandemic. Where is it at? 32. You know what? We'll just say 20 because it's 32, 20, 23. So we'll say it's a 20 PE. And the discount rate is 3%. Why? Because that's the federal funds rate, bro. Let's go double check. Federal funds rate, 3.25%. Excuse me. There we go. And revenue growth assumption. So here's how I calculated revenue growth. I completely ignored the fact that this company has massive declining revenues. I'm just going to assume it's going to grow at 8% every year because the gaming industry, the gaming hardware industry, is going to grow at a compounded annual growth rate of 8.61%. And the share change assumption. Let's go look at how many shares have they been issuing? Boop, 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 boop. Let's see. Okay, these might be impacted by if they went like public or something. Let's say 2%. They're going to issue shares. Okay. So at the end of 5 years, Corsair, my sweaty, disgusting shark-covered nut hair, is going to have $2.3 billion of revenue. And the stock price at disposition is going to be $26. I mean, I guess that sounds reasonable, right? No, these numbers sound crazy so far. Oops. No, don't do that. And at the year of disposition, they're going to have $105 million in bottom line profit and earnings per share of 1.34. Okay. What's their EPS? Well, their EPS would be negative right now. So I add up all the cash flows and the discounted cash flows, and I get a buy of $28. What is Corsair, my sweaty nut salted horsehair, trading at now? Oh, well, see, it's $12. What? 28? Now, just for S's and giggles, I'm going to say their profit. This is me doing it now. Their profit historically before the pandemic was 2%. Their PE, their PE is all over the freaking place. Let's go look. You know what? We'll just keep it at 20. Why not? We'll do 15 like the market because they're not growing that fast. Discount rate, I would use. Well, you have to calculate the weighted average cost of capital. I just use 15%. Revenue growth, I'm going to go with inflation, like real inflation, not the temporary crap, and the share change. So I would potentially consider buying Corsair at $3.69. Okay. And obviously this is just like a very crappy, DCF. And I've done like zero research into the market, and I've done zero deep dive into Corsair, but I can look at their financial statements. I can tell you they're a freaking disaster. They may have some cash flow trouble because their balance sheet ain't that pretty. It ain't that pretty. And if you discount by the federal funds rate, you're an idiot. I mean, I use 15% because, I'm not buying a stock unless it's super cheap. Even 10%, $4. I mean, this just isn't good. I don't know. I mean, even with an 8% growth rate, their bottom line profit is just not good. At least before the pandemic. After the pandemic, or during the pandemic, 6%, and revenue is going to be 60% because that's what it grew during the pandemic. I don't know. I'm not buying this freaking trash, okay? And just the idea that Jeremy bought this, and he goes in the airwaves with 700,000 subscribers, and he says, the federal funds rate's a discount rate, an overnight lending rate between banks. How is that a metric for, discounting your future earnings? All right, let's do some comments. Corsair the king, my crappy garage. What's up, strong man? LaFufu just made a shirtless video. Yeah, he's really burning me. He's a straight up fraud, but he took his shirt off and he made fun of me. So obviously I'm the idiot here. Jeremy's views are down big time, hovering around 20K views a video. Oh, don't worry. He'll be back. He'll recover once stocks go up again. All the retail will be back, and all these stocks will be going up massively, and they'll all be buying stocks that went up a lot. And Jeremy will be like, it's going to the moon! And he'll have a billion subscribers. His channels, I don't think his channel. I'd have to look at the metrics, but he's got like multiple. He's got another channel now. Jeremy LaFave makes money or something like that. Yeah, you make money from grifting, bussy. LaFufu will be back at the truck stop. Jeremy, I'm coming to Vegas, bro. Let's hang out. Razer and Logitech have far superior gaming products. I'm using a Nintendo 3DS to play Pokemon. That's the gaming product that I buy. I've had that for like 5 or 6 years. Strong man, dropping some dimes tomorrow. Tune in. Yeah, this guy's videos are actually really good. You guys should go check it out. He's entertaining. Okay, he's like me if I wasn't a psychopath and I had like editing and stuff. He jokes around less than I do, but it's not a bad channel, so go check him out. Next time we can look at Philip Morris due to the upcoming recession. Tobacco's dead, bro. It's not the future. I mean, I don't know. I'm more partial to what's that company called? I'm drawing a blank. The company that does, what's the other big tobacco company? Oh, I'm just kind of tired today. Whatever. There's another tobacco company. Let's see. Tobacco stocks. The hell is it? BTI, British American Tobacco. I like that one simply because I dip Grizzly Wintergreen, and I believe they make that. So that's the only reason I'm buying it. Just kidding. I'm not buying that. You the best. Lafufu selling bus in Alabama. What is he doing in Alabama? I love Lafufu. He ain't going bankrupt. I liked your wife doing the lawn. Yeah, she volunteered. She's like, hey, I'll cut the grass today. I was like, okay, have fun. Imagine Lafufu trying to read a balance sheet just before buying a stock. He probably glances at it. Cash? Cash? Big number in cash? Okay, bye! But Jeremy said that if anybody knows anything about gaming, then they know Corsair is going to do well. Let's just say that. His analysis is very it's all qualitative analysis. There's no quantitative analysis, okay? You need to do like a mixture of both. Like you should like really research the company. You should look at the financials in depth. You should understand what you're looking at. And then you can make an informed decision. You know, you can't go all quantitative and you can't go all qualitative. You should do both. What he does is just, oh, it sounds good. And yeah. Corsair is like a disaster. Absolute disaster. Share dilution is the most likely option. Well, they also drew on a credit line. So I saw that in the last quarter. So maybe they'll just do that. I think Jeremy gets some of his stock picks from people that was paying him money for his private group. I suspect Corsair was one of them. So the sheep led the shepherd off the cliff. I would be very thrilled to get into that group. Wow, Jeremy literally doesn't understand anything. The dumber you are, the bigger your channel. Nonsense. Jeremy's a distinguished investor. He gets 30%. Yeah, like how does the SEC not? I don't understand how somebody can literally have their minions tell people they can expect 30% returns, which is probably like better than Warren Buffett, and you don't get hammered by the law. Like it's just like it blows my mind. Discounting stocks at a rate that's lower than a risk-free price. He's so stupid. He literally said, there's a video I did where I reacted to it. He's like, oh, you know, Wall Street, they do DCFs, and they discount by the federal funds rates. Oh, my God. Oh, I'm just going to say random stuff. That sounds good. PayPal FF, our woke liberal corporate F-ism, because if I say that word, I'll probably get demonetized. And, of course, Jerome is pumping that crap. I should do a review of the PayPal drama that's going on. Jeremy slightly, yeah, I can tell you're not an Echoes fan. Let's see. The predicted compounding annual growth of the gaming industry is currently on a decline, which was at 8%, 8.7%. I mean, I don't know. Even if the gaming industry grows that fast, it doesn't mean Corsair is going to grow that fast. Jeremy posted a new video today saying he regrets his Friday video. The real regret should be his stock picks. What? Honestly, I don't really watch him that much anymore. Even e-gaming 11% is declining quickly. Well, I mean, the recession's like killing everything. This is just a weird time. EBITDA margins are already falling. EBITDA's garbage earnings. BS earnings falling due to logistics issues. It's gotten worse. 65 people are here, man. This guy's going to crush the apes. Look, you apes are going to crush yourselves. I don't have to crush you, okay? You clowns bought a clown stock. I'm just going to laugh while you lose all your money. Spotify is 90 down. Why no updates? Spotify. Did I do a Spotify analysis? If this isn't a good stock, then why am I typing this message to you on a Corsair keyboard? Let's see. Hi, Strongman. I just watched an ad for you. I'm reformed. An ad? There's an ad for me? Lafufu going to be very rich when the market rally for real. Funny now, but maybe not in 5 years. No, because just because the market usually recovers doesn't mean the individual stocks you're buying will recover. Jeremy's YouTube income for sure ain't going to be able to afford his lifestyle and all his losses he's insuring. Yeah, I don't know. His personal finances are probably a disaster, but whatever. That's his problem. Let's see. Jeremy is paid by Tattooed Ballsack. Well, he claims that he's not paid. I don't know, Lufufu. I mean, maybe you're telling the truth, but, I wouldn't put it past him. Jeremy's an idiot for the Fed's fund rates discount, basic risk reward, a huge premium of government corporate bonds. Otherwise, what's the point? No, bro, it doesn't just use the federal funds rate, okay? He has more subscribers than me. That's all that matters. Let's see. I joined his Discord to see what the hype was all about. Never went into it again. One of the mods randomly messaged me asking me what are my stock picks in order to verify that I wasn't a bot. You should tell him VT. Strongman, can you tell the difference? Can you talk the difference between long-term debt and short-term debt? Very simple. Short-term debt is due in a year or less. Long-term debt is more than a year. So you could have like long-term debt that's due in a year and 3 months, and it's all maturing soon, but that may not necessarily show in short-term debt. That's why you have to go into the notes of the financial statements. Like if a company has a lot of long-term debt, you want to go look in the notes and look and see when that debt is going to mature. Because the financial statements, they only show you debt that's coming due within a year in short term. So you want to be careful because if you have this big debt bomb that's coming in like a year and a half, you want to know about it. And I'm not doing that much research on Corsair because I don't care. There's a reason he's in a crappy motel and rented a Kia. And he rented a Kia. Make a gaming channel. You would get more subscribers. And I mean, I don't really have time for games. I don't know. All right, guys, that's it. That DCF was a joke, okay? Don't make any investing decisions on that. But I just wanted to show you how stupid it is to discount at the federal funds rate. Because basically every stock will be a buy if you discount at the overnight lending rate for banks. Anyway, that's it. Enjoy your Lufufu outro, and I'm out.
Oh, merry stock market. Oh, man. Woo!